Myself Pravid Mahakondari, subject name Derivative and Risk Management. Introduction. What is a credit derivative? A credit derivative it is a financial contract that allows parties to minimize their exposure to credit risk. Credit derivative consists of privately held negotiable bilateral contract credit risk over the counter between two parties and creditor and debitor relationship. This allows the creditor to efficiently transfer some or all risk defaulting to the third party. This third party expects the risk return and payment known as premium. Credit is agreement where one party to borrow receive an item of value from another party. The lender of immediately agrees repay and upon date lender assumes the risk borrower not fulfilling the above obligation, leading any number of potential losses of lender. This is not known as credit risk. Type of credit derivative. There are two broad categories: credit derivative. Unfunded credit derivative are in instrument where the seller lender does not guarantee any payment to the buyer. The buyer get paid only when seller receives the loan repayment from borrower. The buyer bears entire credit risk. Funded credit derivative an instrument where seller makes an entire payment cover any future credit default. Therefore, the buyer is not exposed to the credit risk. Unfunded credit derivatives credit default swap. In this derivative agreement, the party sells the CDCs pay regular interest payment to buyer from loan installment to receive from its borrower. In return, a buyer agree to pay the principal amount and any remaining interest in case credit default and occur. Second one, credit spread sweep option. This is option of CDS. It means buyer of the option of a right but not obligation to buy to sell CDS. Specified date, the buyer has pay a premium buy option to the underlying credit default option gets. Third one, total return swap. In derivative agreement, two parties exchange both of credit and market risk. Let's assume the bank company sales of TRS investor. The bank pay interest income capital gains coming from a company. This is investor in a return of investors pay variable interest rate of bank also bear losses of incurred in the loan. Third one, the benefits risk management, liquidity, portfolio diversification, derivatives of contract, forward contract, future contract, swap contract, option contract. Example: suppose a company went a loan of 1 million expand of business, but does not have a healthy credit rating. Bank P, however, issue of loan to company A, but higher interest rate to unhealthy credit rating bank entire the contract. Third party cover of credit risk. This contract will be credit derivative. In this case, bank B is protection of buyer, assume a seller, the protection of seller. C, bank B have pay a PSA, seller C covering the credit risk. The city will be allowing be transferring of loan default risk of seller. Thank you.